Good afternoon, boys and girls. It's Liberty Call for Tuesday, February 8th, 2022. I hope everyone's having a terrific day out there in the interwebs. It's another beautiful day here in Colorado. Clear skies, lots of sun. Wish it would melt the snowpack and the glacier in my front yard, but I don't think that's going anywhere until probably late May. So anyways, I hope everyone, like I said, is having a fantastic Tuesday out there. Kind of a boring day, not a lot of crazy headlines going across my screen here as far as what's going on in the markets and the economy. Let's see. Fed monetary policy in focus is what they're talking about right now on Fox Business. So, but anyways, let's go ahead and take a peek and see how the markets did today. The Dow Jones was up 1.06%, closed at 35,462. S&P 500 was up 0.82, closed at 4520. NASDAQ was up 1.28, closed at 14,194. Small caps are up 1.41%. The VIX was down another 6.21% today, closing at 2144. So, from a perspective of the VIX, we'd like to see that number down below 20. That would give us some, I guess, confidence that some of the volatility is simmering down in the short term. My expectation long term is that we're probably going to see this go. Have a market downturn sooner than later, especially as we get closer to March, when the Fed is going to start their actions as far as reducing their balance sheet and also increasing interest rates. So I'll be curious to see if they, in fact, do a half a point raise, or if it's only going to be a quarter point. All right, across Europe, looks mostly green except for the FTSE 100. Across Eastern Europe, mostly green except for the OMX C25 and the OMX S30. They were in the red. And then getting down to the Asian markets, kind of mixed. Some red, some greens. So all in all, looking across the trading day, kind of mixed in the Asian markets. Mostly green across Eastern and Western Europe, and then nothing but greens here in the domestically here in the United States. So not too bad from a market perspective. Like I said, the volatility is going to probably be pretty bad in the stock markets across the board. For the next, I don't know, I'd probably give it at least a year. It's really going to depend upon what the Fed's going to do. When that first little stumble happens in the economy or the stock markets, say it's June or July, is the Fed going to backtrack and either stop what they're doing or reduce interest rates if the economy gets too bad? Also, from their quantitative easing and their bond purchases, are they going to continue to sell off their balance sheet, or will they continue to gobble up toxic assets out of the market and make those investors whole? So I don't know. It's tough to say. So, all righty. First article I got here: oil down 2% on Iran. Weekly build seen for U.S. crude and gasoline. It's written by Bharani Krishnan from investing.com. Crude prices fell 2% on Tuesday, pausing its rally for a second day in a row on the notion that Iran could add to global supplies if it manages to clinch a nuclear deal with Washington and other world powers to get U.S. sanctions off its oil. Also pressuring crude somewhat were expectations that the American Petroleum Institute, or API, could announce a build in stockpiles of both U.S. crude and gasoline for last week as inventory snapshot after market hours. New York traded WTI settled down $1.96 or 2.2% at $89.36 per barrel. WTI has lost almost $3 or just over 3% since Friday's settlement. Prior to that, it rose for 7 straight weeks, rising 30% and hitting a 2014 high of 93.17. Some analysts have projected that WTI could continue sliding to between 85 and 82 in the coming days if headlines remain positive about a deal on the Iran talks. London traded Brent, the global benchmark for oil, was settled down $1.91 or 2.1% at $90.78 a barrel. Brent has lost 2.7% since Friday's settlement. Prior to that, it rose 27% over 7 weeks, hitting a 7-year peak of 93.70. Talks on reviving the 2015 Iran nuclear deal will resume in Vienna in 10 days after some progress this week, with the United States restoring some sanctions waivers. Washington wants Iran to fully dismantle its nuclear program, which Western inspectors say is advancing towards atomic bomb capability. Tehran denies the notion, saying its nuclear facilities are only for power generation, and is demanding a full removal of sanctions on its oil exports and a guarantee of no further punitive steps. So it looks like we might see some relief at the pump coming up. If things continue to calm down. Obviously, the Ukraine-Russia problems that, from my point of view, the U.S. seems to be making this worse. From folks that I've been listening to who live and work in Russia, and a number of podcasts I've listened to, state it's not quite what we're hearing on our side of the news. So, not that I don't know why anyone would trust the media at this point. I mean, they've lied about. They were consistent liars about Russia collusion, the dossier, the P tape. Let's go back a little further. WMDs in Iraq, which led to a decades-long war and millions of deaths in the Middle East for the locals there. We've had how many thousands of soldiers and sailors and Marines who've been injured or killed over the last almost 20 years of our occupation in the Middle East. And let's go back further than that. Gulf of Tonkin was a lie. So, anyways, why would we trust our government or our media? Because they both cheerlead for each other. So, anyways, let's go ahead and jump on to our next story. U.S. household debt increased by $1 trillion in 2021, the most since 2007. Written by Janelle Marte from Reuters. U.S. consumer debt loads grew in 2021 by the largest amount in 14 years as people ramped up borrowing to afford homes, cars, and other goods that are becoming more expensive, according to a report released on Tuesday by the New York Federal Reserve. Higher borrowing was fueled in part by rising prices as consumers cope with the strongest inflation seen in nearly 4 decades, and households supported by increased savings and higher incomes seem to be handling the larger debt loads well so far, researchers said. The aggregate balances of newly opened mortgage and auto loans sharply increased in 2021, corresponding to the increase in home and car prices. Wilbert Van der Klaauw, senior vice president at the New York Fed, said in a statement, total household debt grew by $1 trillion last year, marking the largest increase in overall debt since 2007. According to the New York Fed's quarterly report on household debt and credit, the total debt balance is now $1.4 trillion higher than it was at the end of 2019. Over $4.5 trillion in mortgages were originated in 2021, reaching its historic high for the database, which goes back to 1999. Mortgage balances increased by $250 billion in the fourth quarter to $10.93 trillion at the end of December. Auto loan originations returned to pre-pandemic trends, but loan amounts increased in response to rising car prices, New York Fed researchers said. As car prices have soared, buyers have borrowed more to finance the additional cost, researchers wrote in a separate blog post published Tuesday. Some borrowers anticipating higher interest rates may also be taking advantage of lower borrowing costs, researchers said, noting an increase in mortgage refinancing. Fed officials are expected to start raising interest rates in March and to begin shrinking their. Yeah, we already know all that stuff. So I don't know if this is a good problem or a bad problem. Obviously, too much debt by a government or a household or whoever, a business is certainly not always a good thing. There are good forms of debt. Obviously, buying a house in a market where the values will increase for the next 10, 20, 30 years. Borrowing the money at a good interest rate, depending upon what the times are at that point, is usually a good idea, especially, if you buy a home for, say, $200,000, you live in it for 20, 30 years, you sell it for, say, double or triple what you paid for it. That's not a bad deal. But, just accumulating debt without any assets to back them up, credit cards, things like that, that's a very dangerous game. And so, looking at, these numbers, at least what they illuminated in their article, most of this debt is attached to some assets. Obviously, cars don't hold their value for what you paid for them, especially if they're new. But, at least there's something tangible, the old debt collector in me who did that for almost a decade, a short time with an auto lender, and tracking down people in their cars is not always the most fun thing to do, but at least you have an asset that you can go back after if the deadbeat doesn't pay you back. All right. Okay, next article. If you're a wage earner, you're going to fall behind. Ex-Fed insider warns of difficult few years due to inflation, written by Jeffrey Bartosh. Former Federal Reserve insider Thomas Hoenig thinks the U.S. faces a painful reckoning because of high inflation. Hoenig was a lone dissenter 8 times in 2010 when the Fed voted to pursue a then novel strategy known as quantitative easing of buying trillions of dollars in Treasury and mortgage-backed bonds. The goal was to flood the U.S. with money and slash interest rates in an effort to juice up the economy. The Fed doubled down on this strategy during the pandemic. Then and now, Hoenig warns the policy could lead to more harm than good. I would happen to agree with this gentleman. Recently, his warnings have gotten more attention. He was the subject of a large magazine profile in Politico, and he was a guest comedian commentator on Jon Stewart's podcast. Here are some of the excerpts from Barron's live interview with Hoenig, the former president of the Kansas City Federal Reserve Bank, on the economy. It's going to be very difficult a couple of years for the U.S. economy and the Federal Reserve. If they raise rates to bring inflation down, then the hard part begins, because when that happens, the economy begins to slow. They'll worry about recession. There will be a likelihood that they ease policy again, even while inflation remains 4 to 5%. On the cost of inflation, people are, if nothing else, sensitive to high inflation. They know what it is doing to them. They know they are losing ground across the board. When you go to the grocery store, you see inflation, and that's what people are paying attention to. On interest rates, I expect a modest in interest rates this year. I expect a modest, probably a modest increase in interest rates this year. Maybe a 0.5 point the first time in March, depending upon what inflation does from here. Then a 1/4 point or 2/4 point for 2 or 3 times following that. Beyond that, I'm not sure. On the Fed's balance sheet, I think they will be very slow in shrinking their $9 trillion balance sheet. It would affect the housing market because they buy a lot of mortgage-backed securities. They don't want to do it too quickly. We are probably talking about a decade to get the balance sheet back to any kind of balance. The thing is, it won't come without a plan. On asset inflation, I was worried quantitative easing would encourage a significant increase in asset values through the stock market, housing, and real estate, all of which happened. On the rich getting richer. If you own an asset, you win just from the inflationary effect. Usually it's the upper middle income and wealthy who are in that position. If you're a wage earner, you're going to fall behind, and you have to borrow more and commit more of your income to housing. On the stock market, the value of the stock market will be under pressure, as we have already seen. There's more perhaps to come. I don't necessarily think it has to collapse. It will grow more slowly. Getting used to modest or no increases in asset values will become difficult. On what investors should do, I wish I had that magic answer. On the Fed persevering, if the economy starts to slow, I think the Fed will fall back from a tightening policy until inflation becomes an issue, such an issue that it forces their hand. If we back away too soon from a higher interest rate environment, it will just delay our reckoning. On Chairman Jerome Powell, I think he can lead the central bank through this, but it won't be easy. He needs the help of Congress. They really need to deal with their spending. The Fed has basically enabled the government to borrow at will with very low rates. So most of those things I completely agree with. He's a little more dovish on a stock market. He used the word collapse. I don't know if I'd use the word collapse. More of a massive retracement would probably be the term I would use there. All right, next article. If you're going to use this common investing tactic, you're almost certain to fail, written by Patrick Villanueva, as published today. After a particularly strong 2021, 3 major stock market indexes have gotten off to a rocky start in 2022. While the S&P 500 and Dow Jones are down 5.92% and 3.43% this year, respectively, the NASDAQ has dropped more than 10% in 2022. Recent volatility may have some investors reevaluating their strategies and continuing considering how they can better time the market to capitalize on periods of growth and avoid inevitable downturns. This concept, known as market timing, sounds great in theory, but it's virtually impossible to put it into practice, according to one expert. Bob French, a chartered financial analyst and director of investment analysis for retirement research, found that market timing strategies are hypersensitive and can easily underperform compared to buy and hold tactics. Mistiming your exit or reentry into the market, even by 1 month, can drastically alter an investor's long-term outcomes. Unless you can predict the future or substantially better at extrapolating trends than pretty much anyone else, there's no way to tell how the markets will move in the short and medium term. French wrote in a recent piece for Retirement Researcher. As you can imagine, this makes it incredibly difficult to successfully time the markets. Benefits of market timing. To illustrate the potential benefits of being able to perfectly time the market, French has calculated the hypothetical growth of just $1 invested in the S&P 500 in 1926. Had the money simply been left to grow over the next 90 years, the $1 would have been worth $57.9953 in 2016. But had an investor been able to perfectly time the market during those 90 years and avoid all market downturns, that dollar would have grown to an eye-popping $356 billion in 2016. Yes, billion with a B. This is perfect timing strategy involves staying invested in the S&P 500 during most months when indexes produces a positive return. Otherwise, investors hold this money in a 1-month treasury bill. Of course, accurately predicting every market drop over the decades-long period is virtually impossible. But even if the investor were able to avoid the worst 5% months during the 90-year stretch, his dollar would have grown to 7.5 million by 2016. In fact, by only missing the worst month during that time, September of 1931, the hypothetical investor's dollar would be worth 42% more than a buy and hold investor who rode all the market ups and downs. Why you can't time the markets? Successfully timing the markets would theoretically produce astronomical returns, but the problem remains. Even minor miscalculations can upend an investor's long-term plan. Mistiming the market can mean foregoing the best months for growth, while a buy and hold investor would have nearly 5,800 in 2016 for every dollar invested in the S&P 500 9 decades earlier. An investor who missed out on the best month during that time span in an attempt to time the market would have 30% less. The gap between those two strategies gets significantly larger when you miss out on multiple growth months. A hypothetical investor who exited the market and missed the best 5% of months between 1926 and 2016 would only have 29.37 for every dollar invested in the S&P 500, nearly half as much as a buy and hold investor. And if timing the markets means missing out on the best 10% of months, an investor would actually lose money. His $1 investment in 1926 would only be worth 31 cents in 2016. Meanwhile, timing the market just doesn't mean exiting at the right time. It also requires re-entering at the optimal time. In other words, you have to be right twice. For a hypothetical investor mistimed either his exit or re-entry by just 1 month, he would still have a large sum by 2016. However, his return would be a mere fraction of what that perfect timing strategy would produce. In the best of these examples, we only captured 0.022% of the perfect timing strategy. In other words, these strategies are hypersensitive to any errors, French wrote. Even when you are almost perfect, you lose nearly all the benefit. To hammer this home one more time, no one can actually be good at this. Timing the market is pure chance, which I'm not willing to bet my portfolio on. Bottom line, timing the market to remain invested in the stock markets only during periods of growth is virtually impossible to achieve. While this strategy would hypothetically produce astronomical returns, minor miscalculations like mistiming your exit by just 1 month can significantly reduce your potential benefits. Bob French of Retirement Researcher writes that you're better off building a portfolio based on your risk tolerance and remaining disciplined throughout different market cycles. So, yeah, I agree. I mean, if you're trying to always, buy low and sell, at the very, most optimum points, whether or not it's for the sell or the buy, that's a very tough thing to do. In my, decade and a half of doing this, there was only one day where I was ever actually completely perfect. And that was, I had one client where we had a big sum of money sitting in cash. We were waiting. This was back at the end of 2008, going into 2009. And I think we invested this gentleman's portfolio on March 9th, which was the bottom of the market. Complete happenstance, accident. Having the conversation with the client prior to that, basically the conversation went like this. Do you think the market's going to go to zero? No, I don't think so. If it goes down another 5% and then goes back to where it was prior to this, is that 5% really going to upset you? No. Okay. So we went ahead and invested in. I mean, I remember the conversations months later. He's like, "Man, you were a genius." I was like, "No, it was just good timing. That's all it really was." All right, and then one last article has to do with some estate planning, which I always like to try and wedge in some financial planning into these conversations. So, what is a family LLC? All right. Limited liability companies can protect your personal assets if you own a business, but they can also be used in estate planning. Specifically, you could establish a family LLC to shield assets from creditors while ensuring a smoother transfer of wealth from one generation to the next. Family LLCs are subject to the same rules and regulations as non-family LLCs, and there are other reasons that might make a family LLC the right decision for you. It's helpful to understand how they work and when deciding if one is right for your financial situation. A financial advisor may be able to help you figure out whether a family LLC makes sense. Try using Smart Assets free advisor matching tool. Blah, yeah. A family LLC is a limited liability company that's established by members of the same family. Participants in the family LLC must be related to one another by blood, marriage, or through adoption. Typically, one family member manages the LLC. Like a non-family LLC, there has to be an operating agreement in place that spells out ownership rights for each member of the LLC, transfer rights, decision-making, day-to-day operations, and activities. The family can create the operating agreement for the LLC, or they can have a business attorney draw one up for them. Having this operating agreement in place is important because it offers some key protections. Specifically, an operating agreement for a family LLC can protect assets if you're sued by one or more creditors, discourage creditors from trying to upset the operation of your LLC, making it difficult for creditors to derail your business operations by attempting to attach assets belonging to the LLC. The operating agreement can also prevent members from doing things that could affect the LLC status. For example, members wouldn't be allowed to terminate one another in an attempt to dissolve the company without the consent of all owners and management. Family LLC and estate planning. Setting up a family LLC, limited liability company can offer asset protection against creditors, but it can also play an important part in estate planning for business owners. They can be used to minimize estate taxes for families that have substantial assets. The IRS makes it possible to discount valuations for assets that are protected by a family LLC. This can allow you to transfer more of your estate to your heirs before you're in danger of reaching the estate tax threshold. For 2022, the estate tax exemption climbed to $12.06 million for individual tax filers and $24.14 million for married couples who file a joint return. This means you can leave the amounts to their heirs and pay no federal estate tax or gift tax. Meanwhile, the annual gift tax exclusion limit increases to $16,000 in 2022, up from $15,000 previously. This limit also doubles for married couples who choose to split gifts. A family LLC can help you to better pace out transfers of wealth during your lifetime in order to make the most of these exemptions and exclusions. Additionally, you can structure a family LLC so that members are restricted from transferring any of their interests outside the family. This may be important to you if you're hoping to create a lasting legacy of wealth for future generations. Family LLC and family limited partnership. A family LLC is one way to manage business ownerships among families. A family limited partnership, or FLP, is another. With a family limited partnership, you have both general partners and limited partners. The general partners control the management and investment decisions of the business, while the limited partners are able to benefit financially from the success of the business. In a typical family limited partnership structure, the older members of the family, i.e. the founders or their immediate children, may be general partners, while the limited partners are among the younger generations. The purpose of the family limited partnership is to make it easier to pass on a business to the next generation and maintain business assets in the family. Family limited partnerships can offer some estate tax benefits while passing on assets to heirs, but in terms of liability protection that's afforded, this only extends to the limited partners. A family LLC, by comparison, would offer more comprehensive liability protection for all members of the LLC. Family LLC pros and cons. There are several advantages associated with establishing a family LLC. In terms of positives, here are some of the reasons someone may consider a family LLC. It can offer asset protection from creditors beyond what's available with a corporation or partnership. A family LLC can simplify the transfer of business assets to the next generation. It can also prevent assets from being transferred outside the family, making it easier to preserve a legacy of wealth. The pass-through entity nature of the family LLCs can allow for preferable income tax treatment. They can allow families to minimize estate tax and gift tax when passing on assets to heirs. On the other hand, a family LLC may not be right for everyone. Here are some chief limitations to know. They're generally not viewed as suitable vehicle for passing assets to minors. Commingling personal and business assets could become problematic. The IRS tends to scrutinize the formation and activity of family LLCs to ensure that they're not created simply for the purposes of evading taxes. Yeah, because the IRS needs more of our money. Cost is another consideration when weighing a family LLC. Can easily cost several $1,000s to create a family LLC after you pay registration and filing fees and a business attorney's fee. So before spending the money, it's important to understand the purpose it will serve you and your family to ensure that it's worth it. Bottom line, a family LLC could be a useful tool for running both family business and managing your estate plan. You may choose this option over a family limited partnership if you're looking for broader asset protection. Whether investing time and money into creating and maintaining a family LLC makes sense for you, however, can depend on the nature of the business and the value of assets you're trying to protect. Tips for estate planning: a financial advisor can be a huge help in the estate planning process. This is just an ad for finding an advisor. All right, so some estate planning tips for those out there. Oh, Barney joined us. You can see him back down here over my shoulder. That way. All righty. So, I hope everyone got some good information out of that. If not, I'm sorry. So feel free to send me any topics if you'd like. I'll be back tomorrow with Wednesday's Liberty Call. If anyone needs anything from me, don't hesitate to reach out via email or phone. And I'll see y'all tomorrow.